Looking for a dime. James Locke in the house, gonna help you shine.
Welcome to the Poole Locke YouTube channel. I'm James Locke. Today we're going to answer 2 more Ask James questions of the day. The first question is from Arnold. And Arnold was wondering, how do I know if I have one of those 60-40 portfolios? All right, great question about understanding your investment portfolio composition, especially when it comes to, what we talk about, retirement planning and managing risk. A 60-40 portfolio typically refers to one where 60% of the investments are in stocks and 40% in bonds. The allocation aims to balance growth potential from stocks with stability from income from the bonds, which is ideal for many investors seeking income in retirement while managing risk. Determining if you have a 60-40 portfolio isn't always straightforward. While investment statements often provide, pie charts or percentages showing asset class breakdown, some investments blur these lines. Certain stocks, like utility stocks or dividend-paying stocks, can behave more like a bond but appear under the equity portion of a statement. Similarly, bond funds, mutual funds, might include riskier assets that complicate categorization of them. Right? To clarify your portfolio's composition, if you work with a financial advisor, they can provide a detailed breakdown of your portfolio's allocation and discuss whether it suits your retirement income needs and risk tolerance. Alternatively, if you prefer to assess it yourself, look at each investment's name and characteristics. Terms like growth, capital appreciation, or equity typically indicate stocks, while terms like income, high yield, or fixed income suggest bonds. For any uncertainties, online resources like Google Finance or Yahoo Finance, they can help. They can help you, understanding that portfolio mix, and that's crucial. Once you know whether your allocation leans towards 60-40, you can make informed decisions about its suitability for your retirement goals. So we often explore strategies to optimize portfolio balance, reduce volatility, and maintain income generation in the future, right? So understanding and managing your portfolio effectively is key to securing your financial future in retirement. So by delving deeper into what makes up a 60-40 portfolio and how it aligns with your investment objectives, you'll gain clarity on how to navigate market fluctuations and achieve your long-term financial goals with confidence. Great question, 60-40 portfolios. If you have a question, we'd love to answer it. Email that question to poollocke@poolelocke.com. All right, moving on. Second question from Claire. My financial advisor gave us a questionnaire about our risk tolerance. But is this all it is? Right? How do I actually determine my risk tolerance? Fantastic question. Delves to the heart of understanding risk tolerance and how it impacts your retirement planning. The questionnaire your financial advisor gave you is indeed a standard practice in the industry. But its purpose isn't solely to, accurately determine your risk tolerance. Rather, it serves as a compliance measure, a way for advisors to document that they've asked these crucial questions. The real challenge lies in how these answers translate into a portfolio that fits you perfectly. Many advisors use an algorithm that matches your responses to predefined portfolio models, which can sometimes feel like a one-size-fits-all approach. However, the crux of the issue, risk tolerance, isn't something easily boxed into a questionnaire. It's dynamic and personal, influenced by your life stage, financial goals, and emotional reactions to market changes. For instance, experiencing a market downturn while you're still accumulating wealth is different from enduring the same downturn during retirement when you're relying on those investments for income. The emotional and financial impacts vary significantly. A truly effective approach to determining your risk tolerance involves personalized engagement with your advisor. It's about having meaningful conversations that go beyond checkboxes. It's about discussing your financial history, your comfort with market fluctuations, your long-term goals, and even your emotional responses to financial ups and downs. These discussions help your advisor craft a portfolio strategy that aligns not just with your financial needs, but also with your emotional readiness to handle market volatility. In retirement, especially, mitigating risk while aiming for income becomes paramount. Your portfolio should be tailored to provide stability and steady income, possibly through a mix of dividend-paying stocks, high-quality bonds, and other income-generating assets. This personalized approach ensures that your investments not only grow, but also support your lifestyle and peace of mind throughout retirement. So while the questionnaire is a starting point, don't hesitate to engage deeply with your advisor. Share your concerns, ask questions, seek clarity on how your portfolio reflects your risk tolerance and retirement goals. A collaborative, personalized approach is key to navigating the complexities of investing for income in retirement while reducing risk and volatility, right? And we often explore many different strategies that can help, achieve financial security and enjoy your retirement years to the fullest. Thanks for an awesome question. As always, if you would like to send in your question, you can do so by email. Send it to poollocke@poollocke.com. And if you like what you heard, go ahead and like and subscribe to our channel. I'm James Locke, your retirement income source, and I'll see you next time.
Money on my mind, looking for a dime. James Locke in the house, gonna help you shine. Retirement is near, don't you live in fear. Listen up, my friend, let me make it clear.